Hello, this is George Demaree with another episode of Your Money Matters. You know, we've been doing Money Matters for a number of years now, and I just found that I just love doing this because not only do I pull information to help our members and friends and any other viewers, but it's also information that's helped me. You know, I've become a ton more financially literate just because of the research that I do on Money Matters. You know, last week, we spent some time on terminology, terms like a return on investment, risk tolerance, what's it really mean with interest rates on credit cards. We're going to spend a little time on interest rates today at the end of today's program. But today, Tim, what we're going to focus on? We're going to focus on the asset that builds wealth more than any other asset available to anybody. And where do people have an opportunity to really build wealth? Well, it's in their mortgage payments. It's in the house that they buy. Because one thing about property, over time, as a rule, it always goes up in value. And there's a number of things that you can do financially when you own a house. You know, owning your own piece of property, your land, yours. So today, tell you what we're going to do. We're going to focus on, because let me tell you, the reason we're doing this is because of interest rates. Interest rates have grown triplicate over the last few months. They've dropped a little bit over the last month when this program is being taped, but they're still substantially higher. They're at around between 5 and 6%, some a little over that. They had gotten down about this time last year, right, just a little above 2%. So, I mean, the cost of borrowing money has gone up so much as opposed to how it used to be. So, but today we're going to talk about, when does it make sense to refinance your house? When is that opportunity, should you take that opportunity? Well, first of all, it's when you can lower your interest rate. If you can lower your interest rate a substantial number, many times it makes sense to refinance your house, though sometimes it comes accompanied with some closing costs. But at the end of the day, because mortgages are long-term debts, then that short-term cost for closing is not a big hill to climb if you can save $200, $300, $400, $500 a month on a mortgage payment just because you can lower your interest rates. Remember, that's why it's important. We've talked about this time and time and time again. For you to have a credit rating that's 700 and above. I was just talking to a member on staff, Sharon Bell, a few days ago, and we were talking to anybody with a credit rating of 740, 750, and a credit rating of 830, 830. It's nothing that one person can do the other person can't do. If you got a credit rating at over 740, there's very few things, as long as your debt-to-income ratio is not out of whack, that you cannot purchase, all right? The next thing that you can do if you want to, that it makes sense to refinance, if your credit rating improves. Many times, if you got a mortgage and your credit rating wasn't the best, but you still got a mortgage, but now you've done what you had to do to increase that number, it makes sense that you go and you refinance. Tell you another thing that can happen. A lot of times, if you don't have a 20% down payment, you have to pay what is called a PMI, all right? There's insurance on the mortgage. But over time, when you're making payments on your mortgage, and the value of your home increases, once it gets over 20%, then you can call your mortgage provider and you can drop that PMI. Sometimes it could be as much as $200 a month. Be mindful of that. Many times you want to refinance to shorten your term, to go from a 30-year mortgage to a 15-year mortgage. I'm telling you, going from a 30 to a 15-year mortgage will cut your interest more than half. And we're going to talk about that later in this program. It's important because I need you to really understand how these banks are making so much money when it comes to lending money to folks. I mean, they are making tons. Again, another reason to refinance is when the value of your home improves. We talked about PMI. And finally, a really strong reason many times is to go from an adjustable rate to a fixed rate. Now, adjustable rates, as a rule, are lower interest rates compared to fixed rates, but adjustable is based on time. You can have a 3-year adjustable, a 5-year adjustable, a 7-year adjustable, but when that period is over, then there's a limit they can usually go, but your interest rate is more likely to go up. So if you can take an if you're going to be there for a while, and you can take an adjustable rate and make it a fixed rate, it's a good thing to do. Moving on. Well, when it doesn't make sense, when refinancing doesn't make sense, when you have to pay a prepayment penalty. Now, I want all you guys to be aware of lenders that one of the terms in the contract is for you to pay a prepayment penalty, which means if you pay the loan off prior to the end of the term, they charge you a penalty. I don't think that's right. That's close to predatory lending. And if someone wants to hit you with a prepaid penalty, go to a different loan provider. But if by chance you are stuck with one, it may not make sense for you to refinance. If you're moving soon, obviously if you're going to move soon, don't refinance, because whenever you do refinance for the most part, it does cost money to do. Sometimes it's not as much, but there are some closing costs that come accompanied with refinancing your mortgage. When you have an existing home equity loan, there are times when refinancing doesn't make sense when you have a home equity loan. And finally, if you're about to pay it off, be happy and don't refinance. You know, if you got a couple, 2 or 3 years left on your term, I'm thinking 5 or less, then unless the interest rate is so daggone low, why would you refinance for 10, 15 years if you only owe 5 or less on the terms of your current mortgage? Moving on. Let's talk a little bit about loan terms and interest rates. I have spent time on interest rates on the last number of Money Matter programs because I think it's very important for you to understand that when you make a major purchase, especially a home or a car, the first thing that you purchase, you may like the home that you buy, that you're looking at, and you may like the automobile, but the first thing you purchase before you purchase that item is you purchase the money. So let's talk about that for a moment. I got a few illustrations. A 15-year, $200,000 mortgage loan at 5%, and 5% is a pretty good rate these days because the ones I've looked at just recently have been closer to 6. But at 5%, the principal and interest payment on that would be $1,581. Now, let me remind you, that's principal and interest. It doesn't include the escrow for taxes and insurance. So taxes and insurance are always a part of your mortgage payment. So, but let me tell you what that really means. Now remember, that's a 5% interest rate. But over the course of the life of that 15-year note, you will pay $84,685 in interest. That's if this was simple interest, and remember what simple interest is. Simple interest is if you borrow $1,000 and you're paying 20%, then you owe someone $200. That's simple interest. But this interest, it doesn't work like this. It's amortized, all right, over time. And because of that, that is 42% of the original principal. That almost $85,000. So if you kept that mortgage for 15 years, you would eventually pay $284,685, not counting your escrow payment. Now, watch this. On a 30-year note, and most Americans have 30-year notes. The reason they have 30-year notes is because it lowers the amount of their monthly payments. You have to be aware of that. We've talked about that with automobiles. So at a 30-year note, a $200,000 mortgage at 5%, now your payment is only $1,073 as compared to the payment on the 15-year note that was $1,581. But because it's a 30-year note, the interest paid on that is $186,511. Compared to the original note, that is 93% of the original note. So do you understand why these banks and mortgage providers who have money to lend are making so much money? If you have hundreds of mortgages out there, and the majority of folks have 30-year notes, they are paying a ton of money, I'm telling you, before they end up paying it off. Now, let me share this with you. That additional $500 per month literally cut that 30-year note in half. Because that, if you look at a mortgage calculator, the interest doesn't change. So that additional $500 goes right on the principal, and it cuts it in half. And if you have a 15-year note, and you pay, depending on the size of your mortgage, this is an estimate, and you pay an additional $250 a month on that note, it will take your 15-year note to 10, just for another $200. Next question, big question. Should you pay your mortgage early? I say it depends on your circumstance. There are a few investment brokers, financial advisors who advise you to pay off your mortgage early, but I think and it's a good thing. Don't get me wrong. It's good to be able to own a home that you don't have to pay a dime on, but I also believe it depends on your circumstance. Does it make good financial sense for people who are truly financially literate and know how this game works? You will always save, remember this now, you will always save on interest if you pay off most any debt early. Notice I said most any debt early because some debts have a prepaid penalty. I think it also depends on how long the debt has been outstanding. Tell you what I mean by that. If you had a 15-year note and the interest rate on that note is 2.5%, and you owe 4 years or less on that note, now, because remember, the majority of the interest is paid early in that period. So now most of what you're paying the last 3, 4 years, especially the last 2 or 3 years, is all principal for the most part. And let's suppose it's $50,000 to pay it off. Does it make more sense to keep your 50 in the stock market or any other investment vehicle where you could be making, heck, because of the increase in interest rates, now if you go to a high yield bank or where you can get a high yield savings account, you can make 4.5%. So if I could take my $50,000 and make 4.5% on that money, it may make better sense for me to keep paying that mortgage because that mortgage was less than 3%. You see what I'm talking about? So you need to talk to a financial advisor. Again, it depends on the terms of the note, the interest rate. Another thing that you need, let's suppose you do have some money where you could pay it off. Do you have an emergency fund? It is important that everybody has an emergency fund because you're going to have an emergency. I think if I've done 40 money management programs over the last 3 years, at least 20 of them I've talked about an emergency fund. So I guess this will be the 21st. And do you have any other high interest debt? It makes more sense if you got cash to pay off a high interest debt than it is to take your cash and pay off a low interest debt on your mortgage. If you have to make good decisions as it relates to where you spend your money, right? Next. Spend a little time on auto loans. I always spend a little time on auto loans. And I love autos, don't get me wrong. And I don't want dealers to get mad at me, I really don't. But auto loans, you've got to understand how that game is played, and I mention it pretty often on these shows. A $30,000 note, which is not that big anymore. I mean, cars are expensive, whether it be used or new. A $30,000 60-month auto loan is 6.7%. I use that interest rate because that's what I saw online. The interest cost on that is $5,388. Now, remember they said the interest rate was 6.7%, but the money you pay back is at 18%. I'm telling you, this is how this game is played. You got to understand it. At 5%, and this is where when interest rates go up, how it's hurt the middle class and people who don't have as much money for down payments. At 5%, that money costs you almost $4,000, and that's 13%. Now let me tell you something else I've noticed. I went on the line and looked at it today. Most auto finance companies are promoting 72-month loans. Well, why? Why all of a sudden? I remember, not so long ago when 36-month loans were, and then it went to 48 and 60. Now it's 72. Why? For 2 reasons. It lowers the monthly note. How often have you gone to an auto dealer and they go, well, this is only going to cost you $350 a month, or this is only going to cost you $400 a month, not knowing the terms, long-term terms of that contract. Well, you think I can pay $400 a month, but for 72 months, that's 6 years. The other is they make more money the longer term of the debt. They make more money on 30-year notes for mortgages than they do on 15, and I'm telling you, they make more on 72-year notes. Here's the numbers right here. A $30,000 car at 72 months at that same 6.7%. will cost you $6,500 as opposed to 60 months at $5,300, and if 5% will cost you $4,700 as opposed to a little less than 4. So remember this, not only do you pay more if the interest rate is higher, you pay more the longer the term of the debt. Finally, understand where you are financially, and I'm going to finish with take a financial snapshot. List all your income. Gather all your bills, debts, loans. Add the cost of living for food, clothes, transportation, home, vehicle, what Dave Ramsey calls your 4 walls. Find out what's left. Gather all those documents, data points, understand the interest rates of the cars that you have, the payments of your car payments, and understand where you are financially. Once you get that together, then you can work on doing some of the things you need to do. Well, that's our program today at Your Money Man. I hope that helps. I hope that helps to help you to understand what interest rates look like and how you can use them to help yourself. Now remember this before I close. Compounding interest on a savings account helps you, all right? Compounding interest on your credit card will never help you. Have a good day. This is George Demaree, and as always, at St. Stephen Baptist Church, God loves you, and so do we. Goodbye.